Today we're going to be discussing considerations when trying to match effective estate planning solutions to established client needs. I'm Nick Priest, part of the Strategic Partnerships team at Downing. I'm joined by Matt Pitcher, independent financial advisor, founder and managing partner of Altor Wealth, and from Technical Connection, Tony Wickenden. Before we get to talking to our experts, let's look at our learning objectives. Firstly, understanding the current legislative context of estate planning. Secondly, appreciating the wide range of potential client aspirations in relation to intergenerational planning with the main asset types. Then appreciating the role of combining estate planning solutions to achieve good client outcomes. Let's start out by looking at some of the legislative context and discuss how to deliver estate planning alpha as an advisor. So, legislative change around inheritance tax has been a hot topic for years, not just around more recent budget statements. Whilst acknowledging things can change in the future, we need to remember two things. Firstly, advice can only be given within the framework of existing legislation, and not doing anything for fear of future changes can create tomorrow's problems. Secondly, to consider how static a lot of the IHT legislation has actually been. For example, the nil rate band has been at its current level since 2009, and the annual gifting exemptions have been in place at their current level since 1981. So Tony, what does the IHT landscape look like? How much does it mean to the revenue? How much of the population need worry about it? And what impact do those frozen thresholds have? Also, how many of the questions can you remember?
That's the best question. A quick word on estate planning alpha to start. It's a sort of subset or a really big contributor, in my opinion, to advice alpha. That is leaving the client better off sort of with you than without you. And so in estate planning context, that basically means that leaving the family better off for your advice, which will also be helpful for your business, of course, if you're an advisor, because you'll have a relationship with the next generation. So that said, i.e. let's look at aiming to leave a client's family better off with you than without you. Those questions, the context, because I think to be able to deliver estate planning alpha, like all advice alpha, depends on two things, I think, really. And I'm sorry if this sounds a bit patronizing to everyone watching, but having good contextual knowledge, which is the questions that you ask me, what is actually going on with the legislation, and then very good specific know-how, which is, I guess, what Matt's here for, importantly, to know what's really important to your client and to know what solutions actually will work for your client. So that contextual piece to those questions, if I can remember them, from what you just said, Nick, what does it mean to the revenue? IHT, it's not a huge contributor. It's 0.25% of GDP is inheritance tax. It's about £7 billion going upwards. I mean, it's been going up since 2009. You've referenced that freezing of the nil rate ban in 2009. A lot of the stats that we get from OBR, from IFS, all these people just say, look, from 2009, when you measure the increase in values, it's quite significant, massive increases in value, 70% increase in property value since that time. So you're thinking, I can see how that has driven the inheritance tax yield up, because it has. And another big contributor is that so-called fiscal drag, and it has application in inheritance tax too, because it sort of goes by the board with the more recent freezes, but that nil rate band threshold, as you said, I said threshold, I meant threshold, as you said, is showing my roots, 325,000. It's been that way since 2009. So that drags more people into it. What it means to individuals is those individuals that are affected are obviously very affected by it, and it gets them angry. A fairly recent YouGov survey, it's carried out once every 2 years, I think, but it always shows inheritance tax consistently polls as the most disliked of all the personal taxes, which you can sort of understand. That's I've been working all my life, paying my taxes, and now you're going to take another 40%. So I think when you mix all that together, it's becoming more important. It's by no means the most important tax. It makes people angry, and there are a good range of solutions available where advisors can really show, look, there are choices and we can really help you make the best of them. It sets this whole area up as one that is, I think, really, really important for advisors, especially since I believe from our work with advisors, a fair proportion of the client base of many advisors are in the sort of age range where inheritance tax is starting to become more important.
Right, Tony, look, thank you. That sets the scene really nicely. Over to you, Matt, now. So when you advise clients, let's focus a little bit on the clients. How does that tax conversation around inheritance, how does that develop? Do you have to, is it like leading a horse to water, or do you have to bring it up?
It is one of those taxes, Tony's absolutely right, where it generates huge amounts of heat, but actually not a lot of light. There's a lot of passion and anger about the tax, but from a much broader range of people than it actually applies to. And even for those that it does apply to, when we're talking to them about it, they often don't have a lot of the detail. So they don't understand the impact. They feel it emotionally. They don't like it as a tax, but they don't understand the numbers. They don't understand how much they'll have to pay. They don't understand their options. So we are very often proactively bringing it up with the client. They're aware, but we need to dive into the actual practicalities of how it's going to impact on them and on their family, because of course it's not a tax they're going to pay. It's about the next generation.
Okay, so could you give me a couple of examples that sort of typify your experience with clients then?
Yeah, so I think clients were always really shocked about the number. The number's always a bigger one than they anticipated, just because it's one of those taxes where you just go straight from nothing into a very large percentage of the wealth that they've got. And what we found actually is what's most impactful with our clients is we use cash flow planning software. We use software called Timeline, which shows the evolution of their IHT liability in the future. And to the point that Tony was making about these frozen thresholds, actually, as estates you would hope would grow, because we're hoping that we're growing people's wealth, then it's growing and creating an ever larger amount that's going to be taxed. So if you can show a client at whatever stage of retirement what the tax looks like now and how it's just rising and rising and rising into the future, it's really powerful. And that really gets the juices flowing, gets them thinking about, well, actually, I want to do something about this. I don't just accept that this is the status quo. I want to take action.
Tony, you've been working in this arena for a long time now. Can you talk about some of the things that Matt needs to consider and what limitations for some of these solutions, what limitations some of them have?
Yeah, it's a tricky one because planning for inheritance tax, the best form of planning is give everything away, don't own anything on death, then there won't be a liability. Okay, most guys go, yeah, in theory, but in practice, it's not really like that because mostly the two biggest challenges, I'm not sure if you'd agree with this, Matt, is access and control. Would you think of clients go, I would give it away, but I want to control over when they get it and who gets it, and I actually need some money myself, either continually or maybe later down the future. I can't afford to just give it all away now. And they're the challenges, coupled with the legislative challenge of the HMRC going, if a gift's going to be effective, guess what? You're going to have to make it a gift where you can't have anything back. And that's where that legislation from way back 2006, and the gift with reservation provisions backed up for certain assets by the pre-owned assets tax provision. Basically, unless you make that gift and you can't enjoy any benefit from it yourself, then it's not going to count for inheritance tax. You'd have done it legally, but it won't count for inheritance tax. So against that background, people want access. A lot of people want access, not everyone. Want control. And the HMRC is saying, and to be effective, you're going to have no benefit yourself. What planning can you actually do in practice? And so you've got, actually, there are some things that you can do in practice, especially if you've got money available, if you've got cash and investments. It's a little more difficult, and I think we'll talk about this a little further on into this discussion, I think, if you've got property and all the rest of it. But there are many things that you can do, and let's not forget, because I'll refer to this more than once, is the power of ordinary insurance in trust to pay the liability if you can't do anything to get rid of it.
Yeah. Okay, so Matt, taking what Tony's just said there, taking it into account and going back to your client interactions, can you tell us about experiences where clients have actually taken action? So they've come to you, or you've gone to them, they've actually taken action, and how they've gone about that and where it's led to.
Yeah, so I think again, Tony's right. The access you can get around because you can plan with the client how much capital they're going to need for their own purposes, for their own retirement. So that's easier to work with. That's easier to advise on. I think the big problem is control. So it's the son-in-law or daughter-in-law problem. That's the issue. So a lot of our clients, and I'm sure we're not alone in this, are very happy perhaps with the children, but are more worried about 50% of any gift walking away with a errant in-law effectively. So that creates an immediate problem, and there are restrictions on what you can do now to work around that. So I mean, I've been doing this for longer than I'd like to think, and I've seen probably every attempt at inheritance tax planning there is in the UK, I would imagine, to varying degrees of success, I think. So lots of clients that have given away properties or given away assets, some that have come to regret that in the fullness of time. Lots of trust planning, just about everything that you can think we have seen or have been involved in at some point.
Okay. And I guess that's, that's the thing, isn't it? At a client level, that's the point that you're worried about is the bit you're describing there where people have done something and then regretted it later. That's what leads into the worries that you have to face when you're trying to get these plans in place. Okay, well, Tony, so you mentioned, we were talking earlier about an all asset approach to this kind of intergenerational planning. Do you want to talk to me a little bit more about what that means?
Yeah, I'm very happy to. Like Alpha, it's one of those themes we've been banging on about a technical connection for a number of years. Okay, this isn't new stuff now, but as an advisor, to give a truly much used word, but true nevertheless, holistic service, it is important to take that wide range of assets into account and not just focus on one thing. When it comes to retirement, for example, you go, oh, it's just about doing something with your pension. No, it's about much more than that, and the world's changed in relation to how we consider all of our assets. So this all asset approach, I think, runs through pretty much the entirety of the wealth management creation transfer journey. So when it comes to the transfer bit and the all asset approach, go, okay, what can you do? And I referred to this in my earlier response to you. What can you do in relation to inheritance tax planning that gives you access, gives you control where you need it, and is effective for inheritance tax? Depends not on the theory, you need to know the theory, but depends on the practice, and the practice depends on what you've got. So use your nil rate band. Yeah, but I've only got a house. So I don't do that during my lifetime to get another one back in 7 years. It's quite hard. So I think we can put to one side, planning with your main residence is difficult, but not impossible. It's quite interesting, some of the things. One of the things you can do is leave your house. Oh, sorry, stay in your house, give it away. So give your house away, stay in it and pay a full market rent, or have the donees come and live with you. So for some people it will work, but for most it doesn't. Either of those two are a little easier with other property. It's when you get to business, businesses, as you'll know very well, with business relief and farms, you go, actually, if you do it right, you haven't really got a problem, which is fantastic. And you've got access and control, which I'm sure you'll have something to say about later. But if you want to do something with access and control without using that asset type, and you're not thinking about your pension because that's free of inheritance tax too, then if you've got cash, you can do, as I'm sure I know Matt was referring to, with regard to those solutions where you can do that thing around, oh, I don't mind leaving it as it is, but that increase in value, which Matt referred to really well in terms of that it just goes up and up and up, the increase in value, especially with the frozen nil rate band, the increase in liability. At least you can cap that with a loan trust, for example, tried, tested, not unchallengeable, nothing's unchallenged, but it hasn't been challenged. The legislation permits it, it's all good. Oh, I don't want that. I want a regular flow of income, which you can also get from a loan trust, but I'd like to get it out of my estate now. The discounted gift trust and the many variations on that theme also works fantastically. Or sometimes a combination. I know we, over the last few months and years, have been talking a bit about combinations of things with estate planning. So putting just those two bare bits together would solve a lot of the problems for a lot of people who have the right asset type to implement them, i.e. the cash. And if they're thinking, well, I've got some investments, I'd like to come out of those and use the cash to do one of these plans, then I'd say absolutely consider that, subject to the commercial implications, and let's not ever, ever forget about capital gains tax when you've got chargeable assets and doing inheritance tax. If you're going to realise the asset and create a gain, you can trigger a CGT liability to try to achieve a future inheritance tax saving. So bear that in mind, especially if you're advanced years, because best form of CGT planning you can do, as you well know, is to die, basically. It's a bit drastic, but it
most
works.
Fun, but yes.
It works, yeah, quite. So the all asset bit is nothing more than that. Let's consider everything and keep in mind, as I know good advisors do, that turning planning theory into planning practice does really depend on the asset that you've got.
So yeah, so one of the main points you were making there is that, there's obviously, in this all asset approach, there's obviously a greater scope for people who have cash and investments, for them to be able to use them in order to turn this strategy towards inheritance tax at a later point in their life. And you mentioned as well there, about making gifts and using things like discounted gift trusts and the immediate impact that brings. ostensibly for a client who has an IHT liability, putting place in a plan to stop it getting worse, you could use, as you mentioned, a gift and loan. So when using these different kinds of mechanisms, if you like, what sort of things should an advisor like Matt be keeping in mind?
I think the underlying sort of watchword, as it were, is that watchwords is that advice alpha, and that is the specific know-how and the contextual knowledge. So the contextual knowledge, what's going on, what can you do, what works, which I know Matt knows absolutely, having been in the business this long. And then that all-important thing that only the advisor, only a good advisor knows, is the specific know-how. That is knowing what's important to your client. And to that last point of control access, well, let's not beat ourselves up with trying to get a plan that delivers control and access if that's actually not important to your client. So it seems pretty obvious, but talk to the client, understand them, as I know good advisors do regularly, to find out what's important to them. Where do they want to get to? Who's important to in their lives? Who would they like to benefit? And how do they feel to those other points around, you know, the people that your own children have married or in a relationship with? All of those feelings, they really get underneath all of that, and to find out what's important. And then from that what's important, you have the idea of what the plan is, and then of course pretty standard stuff, find out what's important, work the plan out, and then the solutions to help implement that plan, which helps the client achieve their objectives. And then, probably most important of all, keep it under review, because you know, in that whole intergenerational space, there is nothing that changes more than how you feel about people, is there really?
Yeah.
Definitely. And of course the amount of money you've got.
Okay, well, look, let's move that point to you then, Matt, and say, look, with these types of solutions that we've been discussing now, yeah, what are your experiences with them, and can you tell us a few pros and cons that you've experienced on the front line?
Yeah, certainly. So I think if I can start with the negative first of all, if that's allowed. So when I've seen inheritance tax delivered in the past, very often the advisor has started with a solution. So because they are strong in a particular area, so if it's an investment manager AIM portfolios, or if it's an advisor who's particularly focused in on discounted gift trusts, it very often seems like whatever the IHT question is, the solution is X. When actually in reality it needs to start with the client. So it's what the clients need, so what their capital position is, but importantly some of those emotional things about, am I happy just to give it away? And one of the benefits of trusts is that they're proven and they work. One of the drawbacks is they can be quite inflexible, so it can lead you into problems further down the line. And in fact, you know, we've spent probably as much time unwinding trusts as we have putting them in place, because they've stopped being the right solution for that particular client or that family. So I think it does depend largely on the client and their own position. We've talked about the loan trust for capping growth in capital value. Just towards the end of someone's career, when they're late career coming into retirement, perhaps those golden years where the kids are off your hands, mortgages paid off, all of a sudden you've got surplus income for the first time since you can remember, then surplus income trust, so regular gifts out of income, which can be quite sizable if it's someone sort of towards the end of their career, into trust. It's just making sure that you're deploying all of those solutions to make sure you're using all of the obvious legislative allowances before you get too clever and start playing around with some of the more complex planning. So it's making sure all of those things are covered off, and that means you've got to be a good generalist in IHT planning, because you've got to understand all of the solutions to be able to deploy as many as is relevant really to the end client. And there's so much, I mean, Tony was saying it earlier, there's so much that you can do to avoid inheritance tax, such a broad range that really, unless you've got a client that's super, super wealthy, you ought to be able to get most of those IHT liabilities down very substantially, if not to zero, given long enough.
Sure. Okay. So let's have a little look at some of those solutions and how you would, when talking to a client, how you would draw out the particular benefits for the client. So let's focus on something that's obviously of interest to me, business relief, but also then Tony mentioned earlier on talking about loan trust for people who didn't want to make the situation worse. And then also let's look at a DGT, which I think, you know, brings in some of the points you were just making there about what's suitable for a client now versus what's suitable for a client when they started out.
Yeah, so from a trust point of view, really, it's back to what Tony was saying about what you're looking for. How much access do you need to your capital? If you're the sort of person who's got, or you've got clients who've got gold-plated final salary pensions and all of their expenditures covered in retirement, well, great. therefore all capital is surplus, and so you can gift that capital away. That's the simplest solution: is start early, do the simple things, just give the money away. If you've then got any issues with clients concerned about retaining control, then you can go into some of the trust planning. So we've said it's surplus income trusts, gifting the nil rate band away into a discretionary trust, all the really flexible solutions where you can unwind it if circumstances change. You can do something about it at a later date. Once you've gone beyond those, then you start to get into the other things that are possible. So if someone needs the income, you've got discounted gift trusts. If you want to cap, you can look at loan trusts. So there's such a range of trusts available, particularly for people in early retirement, because it's really the early retirees who are probably, well, A, they've got the time to live. So multiple periods of 7 years are only going to be possible the earlier you start planning with clients. But also, they're the ones that are less certain about the future because they've got, hopefully, so much longer to live. So you need to be a bit more flexible. Obviously, when it comes to business relief, that's the sort of thing, it varies firm to firm and client to client, but it's the kind of thing we tend to use later in retirement. So it's something that evolves throughout a client's life for people who perhaps haven't got the 7 years, or they've implemented everything else they can. If they've got shortened life expectancy below that, business relief starts to come into its own at that point. And not forgetting, of course, life insurance, which Tony touched on.
Yeah.
Sure. Okay, Matt, that's really helpful to understand, how you put it into play and practice. So I guess this is a question for both of you, but looking at it from a sort of a technical perspective versus, on the coalface with the clients. Tony, start with you. Would you say that there are certain broad rules of thumb that you have to consider when trying to categorize clients in line with the solutions we've discussed?
Yeah, I would. Definitely, I'm not going to change from what I said earlier. I think that's first, obviously, understand the client, what's important to them. Start with the end in mind, good old Stephen Covey reference. Understand what's important to them, and then match the planning to their needs, knowing the range of planning that's around that will work without any challenge, basically, and those that we've covered, the trust-based arrangements, and of course, business relief solutions and protection. When you look at that range and look outside of the financial assets to consider, okay, there may be other things that you could do, but they probably are going to be treated as a secondary line of planning. Have good relationships with professional connections and advisors who can implement those strategies if they are relevant to you. So and I think, let's not forget, really important, we've talked a lot about lifetime planning, but make sure, maybe not even so much from an inheritance tax standpoint, but have a will, have it up to date. Challenge to everyone out there. Has everyone looked at their will recently?
A little bit of scrambling off
kept it
after
up
this.
to date, all of that. And of course, the good old lasting power of attorney, because you never know how things are going to turn out. Nice to have things pre-done, so you've got that security if needed.
Okay. And then to you, Matt, I guess the same question, about rules of thumb, but more really in the client context. When you're talking to a client, what sort of rules of thumb would you apply to that?
Yeah, so I think the first one is you've got to get to know the client's attitudes towards their family. So maybe as early on as having raised the subject of inheritance tax, you've got to start talking about the family and just understanding the wider family dynamic and the relationships. Because frankly, if you don't ask that question and you start talking about solutions, you may find that that's seed on stony ground, because they're never going to consider gifts.
Do you find some do clients find it difficult to have those conversations, downwards to their children?
Absolutely.
Or their children upwards to their parents?
Yeah, so
self-serving.
Some clients don't want their children to know that they're wealthy enough to have an inheritance tax problem in the first place. Some are very good, obviously, and there's a spectrum of how the family dynamic works. We've got quite a lot of our clients who will pay advice fees for their adult children to get advice from us, and that they find really useful, because they know that it's not that we're going to influence what the children are going to do, but they know that the financial decisions they make are going to be guided. We can't control what they do with any money that's gifted to them, but the client can be confident they're at least getting advice as to what they should do, and then it's down to them what they choose to do as children, as inheritors or receivers of gifts at that point.
It's a great gift as well, the gift of advice.
There you go, the gift of advice,
fantastic.
absolutely. And a 40% discount on the advice cost, because it was going to be chargeable anyway. So so that would be first and foremost. So it's all about the family, actually, more than it is about the tax, I would say. And then the second thing is cash flow planning. I know more and more advisors are doing cash flow planning, and probably this audience are all doing cash flow planning, but it's so powerful if you've got the right tool. It's powerful from the perspective of just giving a client the release and the confidence that they can gift or tie money up and not need access to it. But also, as I said earlier, that just showing them visually, a lot of clients are very visual and not very good with words and numbers, just showing them how this problem is getting worse and it's compounding. The tax is compounding over time, and unless they take action now, it's just going to get worse and worse and worse, and harder to address, of course, as the years roll by. So I would say those two things are the absolute sort of starting point, the bedrock. From there, then it's just about talking about it early, doing the simple, smaller things early. We always say to clients, it's better to start earlier and take small steps that are uncontroversial, that the taxman isn't going to object to, rather than waiting until too late into retirement and then having to do very aggressive forms of very large planning.
Tony, Matt, thank you so much for joining us.
Pleasure.
So, Tony has talked to us about the importance of Advice Alpha, given us a framework for the tools that are available to advisors, and Matt has reminded us that it isn't about solutions first, it's about understanding the client's feelings on, let's face it, an emotive subject in inheritance tax planning. For more information about Downing's range of inheritance tax planning services, please visit our products tab on this website or contact sales@downing.co.uk.